I think today is a great time to buy real estate because of many things that I've mentioned many things in the past, but I mean, I just think it's a great time to buy. You're buying for values that are less than they were in 2022, or at least you have the potential to do that. And I think we have the potential for some good, strong, steady cash flow.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it.
Hey, welcome back to the show. I'm your host, Todd Dexheimer, and I'm going to be talking about a few things that probably affect all of us and affect how we're looking at investing, and really just what we at Endurus Capital are looking at. What we're excited about, what we're being just cautious about, what we're thinking is potentially going to affect us both for the negative and for the positive. So first of all, with some data, Yardi Matrix just came out. National rents dropped $6. So not a lot, but I think it's 0.3%. And that is a drop, $6 down to $17.50 in September. This is the sharpest decline we've actually seen for a month since 2009. So that's a long time. That was the Great Recession, Great Recession. So the GFC. Annual growth slowed to just 0.6%. So we got a lot of supply still hitting the market. There's a lot of headlines that talk about the supply that's not hitting the market. They're like, oh, yeah, we see this huge drop off in supply. However, that is the case in some markets, but that's not the case in all markets. And some of the bigger markets out there, your Dallases, your Phoenix, your Austin, well, like Austin's smaller, but Dallas, Phoenix, Houston, and then a lot of mid-size markets like your Austins, your Charlottes, a lot of your Florida markets, right? They're seeing rent declines. They're seeing continual supply hitting the market, even though a lot of people are saying, oh, supply is dropping off a cliff. Well, yeah, but this takes a while to go through. So there was roughly 474 units delivered over the past year, and that's still well above historical averages. So it's still pretty significant. And a lot of that, most of that, was in the Sun Belt states, right? The Smile states. So, and some of the mountain states too. But most of the Midwest, we've already seen the drop off pretty significantly. And what hasn't dropped off is dropping off in the Midwest. The Midwest has seen a different story, but as far as the U.S. in total, again, rent declines. A lot of units remain in lease-up mode. So over 525,000 units remain in lease-up mode, and I think that's really important. We keep seeing that there's less supply, more demand, but this tells a different story. So operators are continuing to have to drop rents, offer more concessions. And you know it's happening too, and I thought this was interesting, is that it's actually affecting C-class properties, B and C-class properties, especially C-class properties, more than it's actually affecting A-class properties. So A-class is actually fairly stabilized, but B-class has more vacancy than what they traditionally see. And so we've actually seen a year-over-year gain in occupancy of 170 basis points in A class, while in B class, we've actually seen a 6.6% decline, and in C class, a 13% decline. And so we're seeing that C class is getting hit more. And so it's almost it's not a race to affordability. It's a race to luxury. It's a race to get into the nicer units, and they're offering some concessions. So the concessions aren't always baked into the actual rents. So you got to be careful when we look at some of these markets. You look at, hey, Phoenix is doing better, right? They're only 3% rent decrease versus 8% rent decrease at the peak. Well, but how much are the concessions out there? Now, markedly it's better, right? But there's a big amount of concessions. Those concessions, they attract people that want to level up and get into a nicer unit. And that's what we're seeing. So we're seeing that C class is actually struggling more because of the increase in units, and a lot of people thought that A class would get pummeled. And I'm not saying A class is super strong. Okay, it's still weak. And quite frankly, when you factor in a lot of these developers, when they did their pro formas, let's say you actually delivered this building in 2024, or even 2025, your projections were based on what you saw happening in 2022. And so in 2022, rents were increasing, interest rates were low, cap rates were compressed, expenses were starting to increase, but especially somebody that delivered in, like, call it 2023 or early 2024, expenses were low. And that's what you were projecting everything on. Well, we all know what happened. Expenses skyrocketed, right? Insurance costs are way, way up. Property taxes are a crazy amount up. And a lot of other labor rates are up. I mean, ton of expenses are up. And so we're really they're getting affected by those increased expenses. But at the same time, what's happening is there's not the rent growth, and most of them would have projected 3 to 5% rent growth, and they're seeing, in some markets, a lot of these smile state markets, Sunbelt markets, they're seeing negative rent growth, right? And so that is there's a big difference between, hey, we were expecting muted expenses and great rent growth, and now we're seeing heightened expenses and no rent growth or negative rent growth with big concessions, with occupancy that's not quite where it was at the peak. So I don't want to say A class is doing fantastic, because certainly it's not, but it's interesting to see that C class and B class are getting affected more because of the amount of units being delivered. All right. So what else did I see? Oh, I think is really interesting to note, and I've talked about this quite a bit, but Midwest and some actually coastal markets and Northeast markets are being driven by really good job growth, really good fundamentals, limited supply. I actually saw some economic data today, and I don't have it in front of me, so I'm going to probably be a little bit off, but there was quite a few markets in the Sun Belt that are currently seeing job growth between 0 and only about 0.5%. Meanwhile, in the Midwest, a lot of those markets are seeing job growth between 0.5% and full percent or even more. So some markets that you traditionally would expect to have really good job growth, like a Phoenix, is actually really seeing, I think Phoenix was seeing almost 0% rent growth. I think it might have been 0.2%. Sorry, job growth, not rent growth, job growth. So the Midwest is doing really well. I posted or posting an article that Minnesota to Twin Cities is actually seen as the top destination for Gen Z. So for younger people, it's the top destination. Columbus was right up there. Chicago was right up there. So several Midwest cities were right up there at the very top or at the top. New York, 4.8% rent growth. Chicago, 3.9% rent growth. Twin Cities, 3.4% rent growth. San Francisco, which is, they saw a lot of rent decline, obviously. And so now they're finally turning a corner, 3.3% rent growth. Markets like Kansas City, Columbus, Philadelphia, they all have really good occupancy and still maintain very good rent growth. So those are the markets that are actually leading. And the markets that used to be leading for the last decade plus are now the markets that are showing some significant issues. So rent declines have gained momentum in markets like Dallas, Phoenix, Austin, Charlotte. Those led the nation in rent declines, and Charlotte and Austin and Denver are expected to actually continue to lead the country over the next 12 months in rent declines and actually increase more in rent declines. So um, Denver, 4.3%, negative 4.3% rent growth. Austin, negative 4%. Phoenix, negative 3.3%. Um, and then you're seeing Las Vegas, Orlando. I just saw something or read something that Disney World in Orlando is seeing some of its lowest attendance. I don't know if that's the right word. It's some of its lowest attendance on record. So we're really seeing people going, you know what, maybe I'm not going to quite spend as much money on discretionary things like going to Disney World. So that's definitely affecting markets like that. So it's interesting to see kind of the difference in those markets and what's happening there. And I think, look, what does that mean for you if you're in the Midwest or if you're in some of those Sunbelt markets or even mountain markets like a Denver? You have to look at it with kind of a little bit of a grain of salt, right? You have to really try to understand what that means. For Midwest, it doesn't mean it's the best market in the world. What it means is that the market is just slow, steady. It's doing what it's supposed to do. So to me, I don't get too excited about the Twin Cities and Columbus, which we're in, and Louisville, which we're in. And I don't get too excited about those being the leaders in the country, right? It's cool. It's a neat thing to be able to say, hey, you know what? The Midwest isn't so bad after all. But I don't get too excited about it because that's what the Midwest is supposed to do. It's supposed to be slow and steady, and it's supposed to lead the country when everything else is in the dumps, right? It's just what it's supposed to do. So it's doing what it's supposed to do. The South markets, the Sun Belt, and some of the mountain markets, again, they're kind of doing what they're supposed to do. They are these markets that go up and down, and they've all traditionally gone up and down. And so now they're in their little down cycle and they're stuck here for a while. And I think they're going to be stuck here for quite some time. I know a lot of people are thinking that those markets are going to increase in rents, and they certainly could. I might be wrong, but I think a lot of the Sunbelt markets and some of these mountain markets are going to see rent declines or very, very muted rent increases for the next several years, quite frankly. But what does that provide? That provides opportunity. And so I think the Midwest, again, there's not a ton of crazy opportunity here. There's some deals to be had here and there, but it's just slow and steady. So there's not much disruption happening where the South, the Sun Belt, the mountain markets, there's disruption happening. And with disruption comes opportunity. So I think now is a great time to be looking in those markets. I think you got to be smart when you're underwriting them, knowing that you could see a couple more years of some poor rent growth, some higher vacancy rates, that type of thing. But if you underwrite properly, I think you'll come out of it very, very well. I think what's going to get people in trouble is they're underwriting, 3% rent growth type of thing. And they're assuming that's going to happen day one or even after the first, maybe it's 0% the first year because they see with the data, but then it's 3% thereafter. I think that's going to get some people into a little bit of trouble, but they'll probably be okay if they have a long enough runway. They can make it up in the end. So that's the other thing. Just have a long enough runway and you'll be able to likely make it up in the end if you've got a good, strong market. All right. Here are a couple other key highlights. Oh, here's, I thought this was pretty interesting. Paul Tudor Jones, he recently talked about the stock market. And so the stock market's been on fire. And we are 220% of the GDP on the stock market. Usually it's about the same, right? So we're more than double what traditionally the value of the Dow Jones has been. And so it seems like we're potentially heading towards a bubble. But what Paul Tudor Jones said is he thinks this resembles the late 1990s dot-com bubble. And it makes sense because now we've got the AI. So this is the AI bubble starting to come. And I actually can see that. And I agree with his analysis after I looked at it and read it, because we are in the early innings of AI. And a lot of these AI companies are overvalued. There's kind of some mania going on. They're not really making money, but they're getting valued at super high rates. And similar to the .com, I can see that a lot of these AI companies aren't going to last very long, and they're going to go out of business. And some of them are going to still stay in business, but they're just overvalued, and so their stocks are going to plummet. And it's going to be similar to the .com. Now, I'm not saying AI is not here to stay. I think it is. I think it's like the internet, very big disruptor. And obviously, the internet's around today still and doing quite well. And I think that's going to be the same thing with AI. But the internet got overvalued. These companies, these web-based companies got overvalued. And I think the same thing is playing out in AI. So what he thinks is going to happen is he thinks there's going to be a major rally in the market, and that'll continue to go until all of a sudden we reach this bubble pop. And he thinks that you need to be nimble. You need to be cautious because the ending could be extremely sharp. And he thinks, we are at a point where you will make a lot of money over the next, who knows? I mean, it could be 12 months, it could be 2 years, it could be potentially even longer. Sometimes bubbles go on for a long time, but then you will lose a significant amount of money, if not all of your money, on some assets, certainly. So you need to be cautious in understanding what you're investing in. But that was kind of an interesting take, and you can definitely read more about that. Just Google Paul Tudor Jones, or go to ChatGPT and say, what did he say about what's going on in the market today versus the .com bubble. He noted that there was a couple of key differences. Today the Fed is seemingly easing their fiscal policy, and previously they were doing the opposite. And then there's also, obviously, we're in a totally different debt position in the US. So we've got huge, large deficits. So that could potentially shake some things up a little bit. Okay, so the last couple things I was going to talk about is kind of overall, what's going on in the market, in the job market, and things that we're watching. First of all, interest rates. The Fed is cutting the Fed funds rates. That hasn't really played into our interest rates being lowered yet, but I can see that likely coming. So I think we are anticipating rates going down. I don't know that they'll go down quite as much or as fast as what some people think, but we do anticipate that being a potential. And so, we're certainly watching that and how that plays into real estate transactions. I think today is a great time to buy real estate because of many things, and I've mentioned many things in the past, but I mean, I just think it's a great time to buy. You're buying for values that are less than they were in 2022, or at least you have the potential to do that. And I think we have the potential for some good, strong, steady cash flow. There are things that are on the market that you question, are we heading into a recession? Certainly. But I'm not so sure that we're going to be heading into much of a recession if we do hit one. There was a slowdown in job growth. Obviously, we saw in the jobs data that came out. Non-farm payrolls rose by only about 22,000 jobs, which is way less than previous months. And we're losing jobs into the negative territory. I think there was 13,000 jobs or something like that. Um, Unemployment rate ticked up. It's still really healthy, 4.3%. So, that's the other thing. Context matters a lot. We talk about, oh my gosh, we're losing a bunch of jobs. Well, unemployment rate is 4.3%. Let's get real. Like that's extremely healthy. So labor force participation rate also got a little bit higher, 62.3%, which to me, that's still super low. But it ticked up. So more people re-entered or started to search again for jobs. And that could be why we're seeing an uptick in the unemployment. So 4.3% is up, but yet there's more labor force participation. So that kind of affects it as well. Let's see what else. Inflation, CPI accelerated to 2.9%. That's up from 2.7% last month, or actually last data month, right? And so we're seeing that's a little bit of concern. Our core CPI, core inflation, is at 3.1%. So that's really just not changed at all. We are going to start to see, the data is lagging. So we're going to start to see rental data and housing data that probably will bring inflation down a little bit. It would be my expectation, but we'll see what else goes up, right? So if everything else goes up, but in the data of the rents are and housing costs are going down, it might just wash it out. So yeah, I think interesting times ahead, but I think with interesting times comes opportunity. So we're excited for what's coming of coming down the pike is, but we're also we're cautiously optimistic. We don't think we're falling off a cliff anytime soon. We think real estate's poised to do really well over the next 12, 24 months and very much into the future. So, we're very optimistic at what's going on. And even if we do hit a recession, we feel like our properties are pretty well positioned to be able to manage and do well in a recession. That's one of the reasons why we focus so much on fixed rate debt, and we focus on a good ample cash reserves as well. We think those two really play well with each other. If you've got good fixed rate debt, you don't have to worry when the market does shift with your lender calling your loan or anything like that. And you don't have to worry about interest rates going up, and you certainly don't have to time either an exit or a refinance. And then if you got ample cash reserves, you can withstand a few months, or hopefully not much extended period of time, but you can withstand an extended period of time where things aren't going quite so well. So, all right, that's all I got for today. You have a fantastic rest of the day. Make every day a Saturday.
Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.